Good space time, y'all. In this episode of the Citizen Cosmos podcast, I speak with Valerie Tetu, GTM strategy at Lido Finance, a liquidity staking provider across multiple networks, including Cosmos and Ethereum. We discuss startups, DeFi, public goods, data storage, onboarding new users with empathy, and the semantics around pegged assets. We also make a deeper dive into liquid staking, how it works, the associated risks and pros, and voting rights.
Immutable storage that is under my custody, that can't go away, they're valuable records, I can transact them anywhere, is very, very powerful.
What is go-to-market? What does it mean? Like, go and buy vegetables, go and buy fruit? Let's get deeper in it.
So it becomes this passive environment, and that's not a healthy economy.
People start to rip their hair and sell their shirts and their wife shirts and whatnot. So that's what I mean by the peg here.
Take ownership, I guess, of your perception, of your experience. I think it's really empowering.
Before we rock it off into today's podcast, here is a roundup of the latest news from the sponsor of this episode, Cyber. The Cyber Congress DAO has been primarily working on improving the Bostrom hub. This work includes testing of the contracts, new UI features, verification tools for on-chain governance, and polishing the Bostrom DEX, adding MEF protection, new web front, and bringing indexing of chain swaps. To try Bostrom, head now to oversib.ai. Hi, everybody. Welcome to a new episode of the Citizen Cosmos podcast. Today with me is Val from Lido Finance. Val, hi. Welcome to the show.
Hi, everyone. Nice to be here.
Nice to see you, because we tried last week and we couldn't, and but we managed to do it. Yay. So we are here.
Yeah, happy to redo whenever.
I know. But still, it's nice to feel rewarded for something that is going on. It's like, yay, it's finally happening. Anyways, Val, can I ask you briefly or not briefly? That is depends on what you want to introduce about yourself. To introduce yourself for me and for the guests, for the listeners, and let us know what you're busy with right now in terms of work, and what is your focus right now and where is it?
Yeah, so to give a bit of background, my name's Val. I'm originally French-Canadian, studied in the United States and in London. I was focused in business and kind of like tech entrepreneurship during my studies. And I actually was introduced, I would say, to blockchain technology approximately in 2016. So I was taking an options class at the time called Leading Trends in Emerging Tech in university. And the research project at the end of the class was basically, okay, choose an emerging technology that doesn't have many applications on it and write your thesis about what you think that technology will evolve into, and in terms of like applications, use cases, and business applications. At the time, when the professor basically asked us to do a research project, I had just picked up a book from the bookstore. And it was like that book, like Intro to Blockchains, with like blocks on it for those who have read it, very basic in 2016. And I love to do that sometimes, to like pick books in the bookstore and like to see, okay, I don't know anything about this. And let's see where it goes. So I had this and I was like, well, okay, great. This is a perfect example. I'm reading this book, might as well kind of like do it on that. And then from there, when I started kind of like thinking about this more like deeply, I was like, this is really, really powerful. And for me, the idea that really kind of like stood out was really in terms of like disintermediating systems and having like value flow straight to like, we're from one party to another, and thinking about all of the inefficiencies between, and humans love to intermediate processes. Whether we see that in like D2C commerce with drop shipping, we see that with, agencies, brokers, things like that. So seeing blockchain and like disintermediating through code, I thought was really, really interesting. The application that really got my attention was actually not Bitcoin or money. At the time for me, it was IPFS. And the reason for that is that I was studying in the United States and had to transition my medical records over from Canada to the US. And the whole process was basically, I realized, had no custody, like control or even like permission to access any of my records that were in siloed databases and probably paper databases also across my medical providers. And basically they have to communicate with one another from Canada to the US to basically transfer records. And some records actually, for example, vaccination records or something like that, were a bit scattered. And I had a provider be like, okay, oh yeah, I think you got this one. And I was like, wait, it doesn't work. Like that's not how it works. Like it's biological data that's really, really important if you're to make like decisions. So when I saw that, I thought, okay, immutable storage that is under my custody, that can't go away. They're valuable records. I can transact them anywhere, is very, very powerful. So that was kind of like the first spark for me. Now I could see my studies and everything. I actually diverted a little bit, went into AI, was in a B2B SaaS company, did technology partnerships. And then I transitioned to M&A because when the company went public, because I always missed kind of like that startup. I feel like I always love entrepreneurship and love to support entrepreneurs. So that's where I was going. But I was starting to see the applications of blockchain emerge. That was probably in 2019, where you saw DeFi kind of like emerging and started using it. And then I was like, wow, this is becoming like really real. And like there are actually like consumers and end users that can use this. So obviously, like many others, it started to consume a lot of my mind, started reading a lot of white papers, had way too many tabs open on my computer, was thinking about building my own project. And so I thought, okay, this is kind of like the opportunity to leapfrog. Was going around opportunities. And then essentially Lido, I got in touch with Lido and they told me about their vision and what they wanted to accomplish and where they wanted to take it, essentially, and more about liquid staking. And when I heard that, it was like a no-brainer where I was like, this is really, really important, actually. It's more important than what people think. I think liquid staking is, if we talk about the new proof of stake systems that we're building, it's a very key piece of the infrastructure in order to properly align incentives with the chain, with stakers, and with also the DeFi ecosystems and the applications that are being built on those layer ones, essentially. So when I heard that vision, for me, I was like, wow, this is very powerful. And this is something that I think is worth doing. So that's when I came into Lido. My specific role is go-to-market at Lido. So I focus not on the development side, but really like, how do we bring this to our different segments of users? It's a really different question than like what you would ask in Web 2. Because in Web 2, go to market, there's like sales, there's like kind of like marketing, all of that. And there's like cycles and you're intermediating a little bit the access to your product. And in this world, basically Lido is just a permissionless protocol. Like anyone can use it. People don't need to interface with us to use the protocol. So our job is to say, okay, what's our role here? Like our role is essentially to make it as easy as possible to onboard, to educate, to provide the right resources and infrastructure so that we can build this protocol as a public good that can really kind of like serve that financial infrastructure that we're trying to build essentially with a lot of other protocols. If we want this new financial system to really serve everyone in the right way, then we have to think about the different people that are using it, their different needs, their different technical proficiencies and everything like that, and kind of like try to create a system and strategy around that. So that's kind of like my role at Lido and a bit about my background. So
I love when guests give a full story rather than, oh, I work at Lido Finance. Well, okay, but where is the story? Come on, guys. You didn't just wake up working there already. Do you remember the name of the book, by the way, that you were talking about? The one you bought in 2016, the Bitcoin book. Do you remember it, the name?
So it was Introduction to Blockchains, actually. So it was not a Bitcoin book.
Ah, okay.
It's just a white cover with like, I think it was like Lego bricks on it or something. Primary colors.
I think I've seen it.
Yeah, exactly.
When you said about the biological data, I was like, wow. I mean, it's every time I think I've been involved with, and maybe this is, of course, a professional like bias, but I think since 2015 or roughly 16, every time I've been involved with lawyers or anything to do with medicine, you're like, oh my God, guys, really, like, we really need to do something about this stuff. Like, lawyers, medicine, notary work, and you're like, guys, what the hell is going on? Why are we so stuck in the past? Why is that there? I can totally feel what you're saying about moving medical records, definitely.
But I think even beyond that, like you're talking about lawyers and everything, and I think especially like right now, zero knowledge proofs are nascent, but there is the disintermediation that I mentioned, but also verifiability, which in regards to medicine or law or notary or anything like that, verifiability is important. And also disintermediating human to reduce error is very important. So when you think about that, when you see the advances in AI, when you pair all of those together, I think like this ledger, whether that is, I think beyond DeFi, is very powerful in many ways.
Val, you mentioned the abbreviation go to market, GTM. Can you L5 that for me and for everybody out there? Like, let's imagine we are not from the marketing world, which I'm sure not everybody is. What is go to market? What does it mean? Like, go and buy vegetables, go and buy fruit. Let's get deeper in it. Let's like, what is it?
Yeah, so I kind of mentioned it briefly, but basically, best way to think about it, it's literally how do you bring something to market? Now, your market is different depending on what you're building. And in Web3, you have different market segments. So you can think about, for example, like in Web3, there's like often a big part of that is your community. Another part of that, if you're in DeFi, it might be funds, institutions, or like investors that might want to use your protocols. Then you might have just, the unbanked. You might have different types of personas with different, degrees of financial literacy and all of that. You need to think about the different personas that you're going to market with. And then essentially, it's to think about the strategy for onboarding, for kind of like distribution, for promotion, and for positioning, essentially. So it's all about how do you get the right product, the right frameworks to think about it, and the right kind of like marketing strategy around it. So I would say, like, if you want concrete examples, for example, it's like you can choose one specific segment. So like, what would you do, for example, to onboard institutions to a DeFi protocol?
It's a rhetorical question or a question I need to answer? Wait. I'm going to let you answer.
No, I was going to answer it.
Yay! Please do. Please don't put me on the spot, please.
I was going to say, so if, for example, you're thinking about that, you want to think, okay, so what do they care about? That's kind of like the first question that you want to ask is you always, like when you're building a product, and I think this is really important because in Web3, I need to make that intervention because I think it's important, interjection, is to say there's so many features that are being built. So many like new functionality, everything like that. Rarely do we see solutions instead of just building kind of like, features. So rarely do we see solutions to problems. Well, I mean, that's obviously debatable because there are solutions, but having like a very targeted kind of like need and being problem first versus just like building something else, like another, like I'm doing this other thing that like introduces more leverage with like another pools and like you can do this other strategy and whatever, like it's super fun, but what are you trying to serve and what are you trying to do kind of, and like what kind of like user need or desire are you? So you need to think about that first. So like, first of all, is like, okay, for an institution, for example, so they might want to put their capital to work. So you think about ways to do that. So, okay, different DeFi, that's kind of like check mark. They can put their capital to work. Certain will have different like criteria. Some of them will want more volatility. Some of them will want more long-term investments or more passive, more active. It depends on like your user base. Depending on your protocol, you're going to cater to one profile more than another. You might cater more to like a hedge fund and like for a derivatives exchange, for example, but Lido might, for example, a staking protocol might cater more to a fund or a DAO treasury, something like that, where it's more passive. So you have to think about, okay, so what do they want? What are they looking for? And then what do they care about? So for example, if you're depositing money, you would want it to be secure. So you want it to be secure. You would want it to be trustworthy. So what do you need in order to do that, to demonstrate that? For example, like audits or like having transparent code, everything like that. And those are all like important check marks to do. And then in terms of infrastructure, so what are they going to use how are they going to access your protocol? So they'll need to like specific custody solutions. They need a specific UI probably because like they might not understand everything. They might find that intimidating, and the more friction that you cause, like the less appealing it is. And then what else do they need? Like they need liquidity. So how are you going to enable that? Well, you need to integrate across tons of different markets. You need to find partners. You need to be integrated within other protocols and everything like that. So then it's like, okay, now that you know all of these things, that you've gathered all of that data, it's like, how do you execute on that? So there are different ways to do it. So the first piece is to say, okay, what do they need to know? How do we communicate it? How do we express all of those things? Where are those like to educate about the value proposition that meets those needs? So that goes through marketing. So for example, like you'll do campaigns, you'll do education, you might do webinars for them, like because there's a way to like nurture, you might build specific relationships and all of that. Now for infrastructure, you might say, okay, what are the right partners that I need to integrate into my protocol? What kind of wallet providers do I need to like onboard them? In terms of liquidity, if you want to optimize for liquidity, well, you want to say, I want to integrate everywhere. I want to integrate into all the DeFi protocols. So you're going to talk to all of them, try to get that started and like get that right infrastructure in place so that when you can basically onboard them, you have the right kind of like structure ready and you meet their needs, you meet their wants, and you've also communicated it to them. And the last piece that I would say in terms of go-to-market, which actually precedes all of this, is you need to know what is your unique value proposition. For example, in terms of a liquid staking protocol, and I'm speaking because of it's from a Lido perspective, but is to say, what does liquid staking do differently and unique that is not necessarily the same with traditional staking? And why is it relevant? Why does it matter? And so liquid staking, for example, you can say it makes staking more simple because it abstracts all of the complexity. You don't need to run a node. It makes it more accessible. You don't need a minimum investment. For example, in the case of Ethereum, where you need 32 Ethereum, you can say any amount. Also, it is liquid. So it eliminates the opportunity cost of locking up assets and not being able to participate in DeFi, which makes it more capital efficient, which is another kind of like pillar where capital efficiency is super important because you want to put your assets to work. You want to optimize for returns. And so to be able to say, hey, you can earn passive staking rewards while using your liquid staking assets in DeFi is also a huge benefit. And then knowing all of these pillars, like what pillars you stand on as your unique value proposition, will inform all of your strategy. This is kind of like what needs to permeate throughout everything that you say, everything that you do, the people that you talk to, who you want to target, everything like that. Because those unique things that you're going to bring to your users, you're going to want to find even the users that find that the most valuable, because not everything is as great for everyone. So all of that is to say, go-to-market is at a high level, thinking about all of these things, and then putting an execution plan together. And obviously, you work with a team, you have BD, you have marketing, you have all of that kind of comes together to go to market properly, essentially.
Can we hire you? No, I'm joking. No, but a serious question that comes up from all of this, the first thing that springs to mind, it's not the first thing that springs to mind, I guess, to everybody, but it's something that resonates within the experience that I have personally with doing what I do now. And it's interesting that as I was making my notes to ask questions, you were actually answering those notes as I was to go. But one thing that you didn't mention that I would love to ask you, and I know you like that topic because you mention it on your biography a lot as well. How do you align everything that you said with the philosophy and the values, like the philosophical values that you have? Because a lot of the time, what I see, and this is mistakes, of course, I think it's mistakes, at least personal mistakes. And I'm sure every founder, every project out there does that. It's like a lot of the times where we believe in something and our personal beliefs or our philosophical beliefs to say, okay, I have to follow this path. But then when you line your problems, your strategy, your desires, your needs, everything, like and you're like, yeah, but I cannot do it because it just doesn't align with my philosophy. So how do you find that yin and yang balance between doing what needs to be done in order to achieve everything you just said, and between internally feeling satisfied and feeling that zen of saying, okay, I didn't harm anyone, I didn't, kill a fly, I didn't do anything bad, whatever.
I think that's a super relevant question, especially in the context of everything that's happened with FTX and with all of these things. Like, you realize that a lot of these things might not be like, depending on your values, don't want to judge anyone, but depending on your values, it might not be the best alignment. So first of all, I think the best way to reconcile this is work or contribute to a protocol that aligns with your values. I think that that's the first step. If the protocol aligns with your values, there shouldn't be any issue because it's very intuitive. You're working for something that makes sense to you, that you want to contribute to, and eventually that goes into that direction. I think that values in any kind of like organization is people can say whatever they want. We saw it in the case of the recent failures that happened. People can say whatever they want, but you can only demonstrate it in actions, really. And I think it's a really important thing to talk about, actually. I'm happy that you bring it up because in crypto, there's a lot of like narrative culture and hype culture where people actually put a lot of weight on narrative versus like actual products and actual like use cases and actual applications. And a part of their strategy is actually just building narrative and building and sharing words or hype or anything like that, which is very vulnerable on the long term, actually, because like narratives change. Like we know this from history and like human history and all of that. And like humans, our attention moves from one place to another and all of that. And like, but values stay grounded. But if you just act like in alignment with it, then I guess like you don't even need to say anything. People will just, it's like funny because I was reflecting on this the other day and I was like, you know what? Like it's good products. They stand for themselves. You don't need to explain why your iPhone looks great. Like it's like the interface is so well designed that it abstracts the design because it's so well done. You know exactly what you need to do. And I always think, so, and obviously not to be too controversial, but I ask myself a lot that question, even in the case of, for example, Bitcoin, which relies a lot on a narrative. It's like, I don't know sometimes, like, okay, well, if it can't stand alone, like, well, I mean, it can, it's a great technology, but tech has evolved a lot. There is a lot of like alternatives now, and now there's like kind of narrative around it, which is a pillar, but is that fundamentally super strong? I don't know. So anyway, that doesn't really answer your question. I kind of went on a tangent there, but I think going back to what you were saying is in terms of executing all of it, you know what you're contributing to, you know what the protocol, what the vision is, what the mission is. You deduct values from that. If it aligns with you, like it's fairly intuitive in the sense of like how you're going to execute on it because the mission just aligns with it naturally.
I know what you mean. I'm a decentralization maximalist, but I'm definitely not the biggest Bitcoin fan. So feel free to say anything you feel. In fact, my personal opinion about Bitcoin, I've mentioned it on a podcast several times, is a lot worse than most people. So yeah, but it's just a natural topic, those values thing. I've noticed that a lot of like lately, the longer I work with what aligns with my values, the more that question keeps on coming up. Am I really doing the right thing? Am I like really going the right way? But I totally hear what you're saying. I totally agree with 99.99% definitely of what you say. Val, one question I had from everything that you said, or rather one thing that I highlighted about unique value propositions. And of course, you've explained one of the unique value propositions of liquid staking is being simple, what it's offering and giving you the opportunity to do other things, to move your capital more efficiently. What about the dangers of liquid staking? I mean, I must ask that. And I think hearing it from you, from the person who works with liquid staking, will be the most like fair and it will align with the values we just spoke about. Because you work with it, in your opinion, what are the dangers of liquid staking, if there are any, of course?
Yeah, I mean, there's always a risk somewhere. Like someone that will say there's never any risk or anything like that. So definitely that is the case. I think liquid staking provides a net benefit to the ecosystem. I think I mentioned it a little bit about why it's important. But I think I'll reiterate just before kind of like saying the risks of like at least why I think it matters. Maybe just personally, but why I think it matters. So currently, and maybe we can talk about Cosmos actually, because I think it's a really relevant example. For example, in the Cosmos ecosystem, if you're an Atom holder, the current staking yield to stake Atom in your Kepler wallet, for example, is from like 18 to 20%. So of course, as an Atom holder, that is an amazing yield. So I'm definitely going to want to stake in my Kepler wallet. Now that's great because it incentivizes a lot of people to stake and participate in like the chain security. And for those who kind of like are unfamiliar with how that works, it's just that, when people stake, it increases the pool of capital that is at stake, and it incentivizes it actually like validators to remain honest, because like if they're not honest, then their capital goes away. So like proof of stake systems. So essentially, I'm super incentivized to stake. Now, all great. But in the case of Cosmos, now I'm securing the chain, but DeFi protocols that are building on Cosmos need liquidity. They need people to use their DeFi protocols and like interact with them and deposit their Atom to earn yield, to basically so that there's enough liquidity to lend so that people can borrow, and also in liquidity pools so that, people can swap and like actually perform DeFi activities and all of that. Because that's the purpose of it, right? Like if we want to build apps on it, then like we need that. But the problem is that these DeFi protocols are like, well, I can't compete with the 20%. It's so costly. I'm going to have to like basically either create a new token and inflate the supply just to basically be able to compete against the staking rate. So an irrational investor would always like stake on the base layer. So apps, if I'm an app builder, I'm going to say, well, I don't really want to build on Cosmos because it's going to be so costly. It's going to cost me way too much. So the current DeFi apps suffer from adoption because people are not like providing liquidity. for the users, it's not as good either because you don't have the liquidity, you don't have the same offering. And then also the development is also a lot slower because for new developers, they're not going to be incentivized to come in if it's super costly for them to maintain it. So the current apps suffer, the new ones don't come in, and then the user also only stakes. So it becomes this passive environment. And that's not a healthy economy. So it's kind of like say, okay, well, how do you resolve that problem? So liquid staking kind of like came in as a solution and said, hey, you know what? The priority is to decentralize, is to get the chain secure. We can't compromise that. Like, of course. So, because that's the purpose of like these public blockchains, right? Like we want to create decentralized systems that have honest validators that are decentralized enough so that, no one can censor, have full control over it and all of that. So we want people to stake. So liquid staking says, hey, you stake on chain, but as a result, I'll give you a token that represents just a receipt of like your stake on Atom that you can then use in DeFi. So you have like this kind of representation that you can use in DeFi. And then afterwards, you can earn additional yield on it, participate, provide liquidity, use as collateral, borrow, lend, all of these things. So you fuel that economy in the Cosmos ecosystem while the chain is secure. And then when you want to redeem your stake, well, then you use that liquid staking asset to redeem your stake. That's how liquid staking works. So it enables these like economies to kind of like flourish. And it incentivizes users to stake, developers to build, and basically apps to thrive. So it's a fundamental piece of infrastructure, in my opinion, of like why it's really important. Now, there are risks, as you said, kind of like, okay, what could go wrong? What could go wrong? Well, it depends on the way the liquid staking protocol is designed, because different liquid staking protocols have different risks. If you're saying, if I'm Val, I'm by myself, and I'm like, hey, I'm providing a liquid staking protocol, everyone stake with me and I'll give you liquid staking assets. Well, I'll be staking all of the assets and I'll have control over the whole chain, which is actually really, really bad, right? So you wouldn't want that. So a better way to do it would be to say, okay, the liquid staking protocol, for example, in the case of Lido, we don't operate nodes. Lido is a set of smart contracts that basically you stake in this Lido smart contract in the liquidity pools. And the smart contract distributes your stake across Lido node operators. So not only is it like the stake kind of like distributed, but also, for example, you're reducing your central point of failure risk by not staking with one provider that might go down and then you get slashed and you're like, no, I trusted this person. So that's also another thing for the user. The other question is, okay, well, sure. For example, if I do that with Lido, that's better than staking with Val, but who are these node operators like behind the Lido protocol? And can I trust them? Are they decentralized too? So that also depends on like what's the node operator kind of like management and selection kind of like process. Different liquid staking protocols have different views on this. Some of them say we want permissioned sets so that to make sure that they know how to operate a node and so that user funds don't get slashed and that we can trust them. And that may be a bit slower of a process to like onboard and completely decentralize a node operator set, but that's one way to do it. The other way to do it is completely permissionless, where anyone can become a node operator, a validator, and then you can stake with them, you can choose your pool, or you can distribute the assets across them, or you can have like a mix of both. You can have permissioned or not permissioned. You can have different degrees of permissions and different ways like that. So those are different kind of like trade-offs that you want to think about. And then the other piece is like in terms of, okay, well, if you have that, how is the protocol governed? So obviously, if, for example, the team that is building the protocol makes all of the decisions on the protocol and they can shut it down tomorrow or change the smart contract code or anything like that, well, you don't really want that, because if it scales and it holds a lot of the stake, like you have to think about the stake as like the security of these layer one networks, which is really important. So you can't compromise that. So that's one of those use cases that actually like decentralized governance is probably better. I think DAOs in general, it's a very like broad concept and it's been adopted in many different ways. But if you think about having a specific set of decisions that are validated and executed by code with like a vote, and it doesn't need to be every decision, like kind of like, oh, what color do we choose for the background of our landing page? But like, do we upgrade this smart contract? Do we onboard this node operator? Things like that are more important, is to say, can we make sure that all of the stakeholders of the network and of the protocol are involved? Now, obviously, it's not perfect yet. Like governance structures and models are still being experimented with. And one thing that I'm super excited about, though, is for Lido on Ethereum, we discussing this on the forum, actually. So would invite anyone to take a look. But at the dual governance proposal, and it's essentially enabling STETH holders, which are the liquid asset holders, to have a veto over the vote of just like, for example, the node operators. So basically the power is distributed across also liquid staker, which is great because it's more representative of like who's actually staking the capital versus just the node operators. So going back to that, I think like the centralization risk can be real because these do have economies of scale. Liquid staking, it does have like economy of scale's advantage because when you think about it, as a user, you want to be able to use the protocol that is the most liquid, the most integrated, and the safest. And what that means is that if it's the most liquid, you want to be able to trade it anywhere. You want to be able to access the capital in the most markets possible, to be able to exit your positions when you want, and on as many dexes as possible. And you want it to be the most composable as well. So you want it to have like the most DeFi strategies to be able to use, because that's like the whole utility of it. Like that's a whole value proposition. Different staking protocols are not as well integrated as others. So if you have a liquid staking asset, you're like, well, great, I have a liquid staking asset now, but this one is not integrated anywhere, so I can't even use it in DeFi. Well, that kind of defeats the purpose a little bit. Well, not totally, but partially. You don't get the full benefit. And then you want it to be super secure. So like, you want it to be audited and all of these things. So it tends to gravitate, but like towards a provider where the liquidity is concentrated. Similar to DEXs, for example. Like, why do people go on Uniswap? It's because your orders, like, there's so much liquidity there that your orders can get executed, and you'll be able to trade your positions like fairly easily, fairly efficiently as well. It's much more efficient. So that's what I would say. I don't know if you have any other questions, like to go deeper into that. But
I have a lot. I have a lot. Believe me, I have them all lined up. No. But you spoke about several types of centralization risk, and you mentioned security risks as well. What about depegging risks? You didn't mention if. I'm sorry if I missed it, but I don't think I heard. Like, what if the asset depegs, the liquid staking assets? Can that happen?
Actually, I didn't mention it because I don't consider that a risk. And the reason for that is actually, so liquid staking assets, peg is the wrong word. It's actually backed. So the way to think about it is your liquid staking asset is always going to be redeemable, the one-to-one with the stake. So as long as you have that staking asset, you can always redeem it for your stake one-to-one. So from the protocol, because the protocol issues the asset, it mints the asset once you deposit. So say you deposit 1 token of Atom, and in return, you receive the liquid staking Atom, you receive 1. So the protocol mints it. When you redeem it in the protocol, when you want to like get your stake back, put it back in the protocol, the liquid staking asset, and then you get your Atom in return, and the protocol burns that liquid staking asset that you were using. So essentially, it's redeemable. It's backed by your stake. The peg is interesting because it's true that the market price might be different. It tends to not be the case for protocols that you can have liquidity both ways. So for example, if I can like unstake and stake and like all of that and withdraw and all of that, there will be, if markets are efficient, then there are arbitrageurs that quickly make sure that it's always kind of like on a one-to-one ratio. Now, in case of Ethereum, that is not the case. We've seen there's a gap between essentially the value of STETH, which is specifically like Lido's liquid staking asset, and Ethereum. And it's also the case for like CBETH or other liquid staking assets. The reason for that is actually you can only do arbitrage on one side because withdrawals are not enabled on Ethereum. So for people right now, for example, like especially in this market, there's some people that have staked Ethereum that they need liquidity now because maybe a part of their portfolio is down, maybe they're a big fund. And for example, what happened with Celsius is like they were going under and then all of a sudden like they needed to access liquidity. So in a way, thank God that liquid staking was there because they could exit their ETH position, which they could have not done otherwise. Like their capital would have just been locked on the Ethereum beacon chain. So until withdrawals are possible, that's still something that we're going to see on the market. But the way that we have to think about it is like these liquid staking assets are a market of their own. So the market is going to price them accordingly.
One more question to dig into that, I think would be fair enough to mention. Before we were talking about the dangers, you were explaining the use cases for liquid staking, and you mentioned capital efficiency, and you mentioned, all these DeFi protocol that need liquidity, da 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 da. So let's now imagine a system. And the reason I say DPEG, and I totally agree with you, DPEG might not be the right word, but there is a reason I do use that word. Imagine if we had a system, and let's think of domino effect here. And imagine my asset that I'm using, the initial asset, yeah, it's backed one to one. And I know nobody's saying it's the fault of this or this protocol. I'm talking in general about the dangers. So imagine this asset is backed one to one, but then this asset is used here, and that is used there, that is used there. And essentially, somewhere along the chain, one of these guys that didn't align with the values we were talking about before because he couldn't care less about the values, because he's just all about the narrative. They don't do that. They offer, I don't know, some kind of premium or some kind of, I don't know, X5 or whatever, some banking multiplier on one of those assets that is in the chain where initially the liquid staking asset is backed by original asset. So as soon as something here in the middle of the chain falls, of course, this is a hypothetical situation, but wouldn't that cause the whole chain? I mean, the market will go panicking. Of course, essentially, our last stop is still backed, like you said, one to one, and those guys are all fine. But the market doesn't really care about that. The market goes into a panic and into a domino effect, and everybody shouting, starting to sell. End of the day, these guys that have, had their liquid asset, they're kind of, oh, we're okay because we still backed one by one, and we can redeem it. We don't care that the market fell. But the thing is, if we were talk about their capital in USD, for example, or in euros, which again, I don't think should be discussed here, but I do want to have the hypothetical question and do want to understand it. Wouldn't that, in your opinion, can cause, we've seen that with Luna, we've seen it with FTX, we've seen it many, many times, not just in crypto. People panic. People start to rip their hair and sell their shirts and their wife shirts and whatnot. So that's what I mean by the peg here, I guess.
If there is kind of a DGen, DeFi pool or whatever that they provide yield in, I don't know what asset they would provide yield in, but something like that, it's not an algorithmic stablecoin. We're not minting, burning, anything like that at all. Like the stake is staked. The asset represents the asset and it's actually floating in a market. So there are traders, there are two sides to the trade. It will just flow in and out of the protocol or be sold. Now, if everybody starts to sell Ethereum, and the value goes down, then people might sell because they need liquidity and sell, but that would affect the value of ETH and SCETH, for example. But there's no mechanism or nothing. Even if people sell, it's the same as the token itself. I don't know if that answers your question. Another question that couldn't be asked though is what if, for example, which was the case for Celsius, they use the ST asset as collateral. And for example, the value of the collateral goes down because the discount starts to widen, for example, which was the case in Celsius. And then they can get liquidated faster, for example. So that could be a risk. That is a risk, for example, because if you're saying, okay, well, I assume that my collateral is always going to be one-to-one with ETH, but actually the value of the collateral goes down because there's a discount, and then you get liquidated in a protocol, that could be a risk. And I think that the best answer to that is really and I think we're all learning from this in terms of the right collateral ratios, the right ways to evaluate risk and to mitigate against that in DeFi protocols, essentially. How, with credit, I don't know if the answer will be credit scores on chain. I don't know if it will be other higher even collateral ratios or what it would be like. But that's something that is valid to think about, is to say, okay, maybe collateral ratios need to be adjusted for liquid staking assets. But it depends on how efficient the markets are. And as you said, if there's a greater demand for liquidity than for anything else, people might exit more of their liquid staking asset positions, which does create more of a discount.
I think we like with any new emergent technology, right? I think we are all here to learn, to experiment, and for sure we will see something that will cause those collapses. We definitely never gonna be able to see it. Hence, that's why it will cause those problems, right? But I guess we're all here to create something and to build, and this is the main thing. Val, before we move on, like to the blitz, quick question, and this is something more commercial, not commercial. I don't know what would be the right word about Lido and the structure of Lido and Neutron and Cosmos and P2P. Like just a quick 101. I mean, I'm personally more or less familiar, but just again for myself and for the listeners, whatever you can share, of course, just in like a couple of words, how does that structure look and who is who, where is what?
Okay, no, that's a good question. So for those who are not familiar, so Lido was incubated by an entity called P2P, which they run validators on different chains. But Lido itself is actually a DAO. So Lido is not a company, it's a DAO. And there are different kind of, for example, like the Lido protocol is kind of like the smart contracts that we're referring to that provide liquid staking. And so there are different teams that build on Lido, like that contribute to the DAO to build on different chains and all of that. Lido is actually not a part of P2P. And so it's actually its own kind of like entity, and it's governed by LDO holders. And obviously it's operated by the core DAO, like it's operated and maintained and all of that by the core DAO. That's like how it works. Neutron is a part of P2P. So they're building kind of like a chain, which is separate to Lido. But Lido is going to build a liquid staking protocol on Neutron. So it's kind of like separate in terms of like the entities.
No, it makes sense. Makes perfect sense the way you explained it. Thank you. Val, blitz, I can't say it's really a blitz because a lot of the guests choose not to answer the questions quickly, and I love it. So feel free to choose to answer either really quickly or depending on the amount of time you have, you can go into details. But there's going to be three questions. So the first one, three projects, protocols, applications, doesn't matter what, outside the top 20, please don't say Ethereum, Bitcoin, Cosmos, that you are curious in terms of what they do, you think it's an interesting emergent or not emergent technology. In any case, it's something that you think it's really cool technologically that you follow. Doesn't have to be three, but let's try.
Yeah, that's super interesting. Ooh, I actually really like this question.
Yay.
So I think one that I find really interesting is Axelar. I think that the problem that they're working on is really interesting. I like the fact that they're tackling it with a proof of stake system. And I find it really interesting that they maintain the state of like different chains. I think I don't know, in my mind, like my mental model for it is kind of like this, like, yes, it's like a routing, like interoperability protocol, but it also kind of acts like an oracle when you think about it, which I think is really fascinating about having that extra layer of like validation on top of it, which I find really interesting. So that's one. The other project that I think will be really interesting is I'm actually really interested in learning more about Mina. So I wouldn't say that I'm the expert on Mina, but I think that what they're working towards is really interesting, and I think that they've been working on their project for a while, like merging kind of like ZK proofs with a very, very light blockchain. Like I wonder where that's going to go. And then the other piece I would say is also I really admire what the guys are doing at Polygon ID. In terms of providing that piece of infrastructure to the ecosystem, I think is very, very needed and valuable. I find that their approach with ZK proofs is great. I really wonder how they're going to integrate it and scale from a go-to-market perspective. I really hope that they can turn up their BD team to really make it kind of like an SSO versus in DeFi and across kind of like all of Web3. Because I mean, personal opinion is that wallets are not an authenticating device, and they probably should not be. So I think that's something that I really support and want to move forward. Oh, and actually I would add one to that is Reserve. I think Reserve protocol, what they're doing is really interesting. So they're enabling anyone to create like stable coins based on a basket of assets and to have a marketplace for that essentially. And I find that super interesting, even as like a thought experiment to think like, what do you consider kind of like a good denominator, and to have that as like a general, I guess, collective experiment. I find that really interesting in the way that they did it with kind of like a marketplace where people can adopt different standards. I think it will be interesting to watch.
Second one, 2 daily activities that motivate you to keep on doing what you do in your life.
I could just say, okay, if it goes into like what energizes me, I would say like for sure, huge breakfast and morning yoga or Pilates. For sure.
I love the breakfast. You won me over. That's it.
Get that done in your day and you're a winner.
That's it. I agree. I'm a huge breakfast person. I'm one of these weird people who can just eat like this breakfast and I don't have to eat for the rest of the day. I'm with you.
Exactly.
Last one. One person doesn't have to be from the crypto space. It could be a writer, and painter, an artist, a developer, a content creator, a protocol founder that you would recommend people to follow or to read if it's a writer that could help to succeed in their lives and to do whatever they do again.
So I think the obvious answer for me would be Marcus Aurelius in terms of like reading about Stoic philosophy. I think it's really important to understand like how to focus on what you can control and focus on your agency and your ownership and like how to basically modulate and like take ownership, I guess, of your perception of your experience. I think is really empowering, is really important. But I would say another one that might be, I guess, more under the radar is Alan de Botton. So for those who haven't heard of him, I would recommend following on YouTube, The School of Life. So essentially, it also goes into kind of like philosophy and self-development and history a little bit. But he provides these like short clips on YouTube, like from The School of Life, that are literally like, why you're gonna marry the wrong person, or like things like that. And it's like very short clips that really like elucidate the truths of like human nature. And I find them like really, really useful to think about. If I can add one more, it would be also Robert Greene's book, Laws of Human Nature, which basically every chapter is like a different law of human nature and also like exemplifying that law of human nature with a historical figure and why it matters. And you start to recognize these patterns across humans. And I think like whatever you're doing in your life, whether that is building relationships, even building a product, understanding the fundamentals of human nature is like a constant that you'll always be able to kind of like anchor in and rely on. Yeah, and it will help you be more like self-aware of yourself, of others, of your environment, and to build from there. So those are the three that I would say.
On the second one, you were like, oh, that's unexpected. I was like, all three of them are unexpected. So that's good. I like it. I really like it. Marcus Aurelius, definitely going to be hard to follow, but for sure it's possible to read. I'm kidding. I'm just kidding, Val. Val, this has been really great. A really, really huge thank you for finding the time, and gonna be watching what Lido is going to build on Neutron with excitement, and not just on Neutron. I mean, I'm saying Neutron because like a lot of people do listen to us from Cosmos, but it's not just Cosmos community. There is a broader communities as well. So everything, of course, you mentioned there is in the show notes. So guys, please do go check all those things that Val is suggesting out. And Val, thank you very much for joining us.
Thanks so much for having me.
Thank you. Bye, everybody. Bye, Val.
This content was created by the Citizen Cosmos Validator. If you enjoyed it, please support us by delegating to Citizen Cosmos and help us to create more educational content.